Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent, and as usual, I'm here with Chris Bates. Batesy, how are we?
Pete, good to chat always. Life's good here. How you doing over there?
Yeah, pretty good, thanks, and loads to talk about as usual. What have you been up to this week?
Well, it was my wife's birthday, actually, so we went up to the Hawkesbury and had a house up on the river there for a few nights. It was awesome, actually. My mum came and helped and took one for a massive hike on Saturday, which was one of those hikes which was amazing, actually. It was like 11 Ks and only saw another couple hiking, and, yeah, it was a proper bush track, so that was amazing, actually. So about as exciting as it gets here, Pete. What about there?
Beautiful. It's a great country. So many people don't get outside of the big cities, and I don't know why, because there's so much to see out there. I've spent quite a lot of the past 2 months traveling around the country. I never cease to be amazed about how much there is to see. What have I been up to? Well, yeah, got a lot of people getting in contact. It feels like we're going into the second half of the real estate cycle, and a lot of talk about another interest rate hike in November. So just got people picking up the phone for a bit of a review on their portfolio and strategy. So yeah, if that's you, drop me a line, because there's a lot happening there. And otherwise, on the birthday theme, it is actually my birthday today. I won't tell you how old. It's an ever-growing number, unfortunately. But yeah, the kids enjoy my birthday more than I do, I think. So yeah, that's pretty much been my week.
Happy birthday, mate. And every year's more knowledge, right? More experience, especially your brain.
More grey hairs, that's for sure.
And grey hairs. It's more distinguished. Right, what are we going to tackle today, mate?
Right, big 3 stories of the week. So firstly, developers deliberately worsening the rental crisis. That was a friend of the show, Dr. Cameron Murray, who made that observation. So interesting talk about whether developers are drip feeding rental supply onto the market. Secondly, economists have released their 2024 property price forecast. So a bit to talk about there. That's actually financial year 2024. So that's the year to 30 June next year. So some interesting predictions there. Obviously, things can sometimes go south as compared to what's predicted, but nevertheless worth a look. And thirdly, a piece in the Australian, well-heeled, still splashing out on property and travel. So despite the tightening of monetary policy, it's not impacted every household, and some of the wealthier households are still out there spending, traveling, buying expensive homes. So we'll have a bit of a deep dive into that as well. So Chris, let's start with this first story. Developers deliberately worsening the rental crisis, ? So a piece run in Macro Business by Leith van Onselen. And I guess, yeah, the general theme here is that some build-to-rent developers have been found to be slowly drip-feeding supply onto the market. And this comes at a time when PropTrack has reported lowest ever rental vacancies for September, and CoreLogic, at least for the capital cities, CoreLogic reported another drop in the rental vacancy rate to under 1%. And yeah, I guess there's lots of predictions out there about, rents soaring 30% in some apartment markets and record high population growth. I think this general sort of observation or criticism of private developers is that I suppose they're in the end incentivized to not flood the market with supply. And we certainly saw that in the previous construction cycle when we got the overbuild of apartments. All the developers said, right, it's no longer going to be profitable in this cycle, and they pulled up stumps. Well, what Dr. Cameron Murray, who's an independent economist, has been saying is that if you look at some of the build-to-rent developments, for example, Mirvac and its LIV Munro developments in Melbourne, they've been basically sitting on empty apartments and just gradually releasing them over onto the market rather than having sort of vacancy periods. And this has been an ongoing theme since the first build-to-rent development in Australia, which was the Gold Coast athletes village for the Commonwealth Games, and it was a staged release over a number of years. So what do you think on that, Chris? It's an interesting point and probably a valid one.
Yeah, so Cameron Murray has got some good insights around all this, where he basically says, if you've got targets, and even if that means the developer could build, it doesn't mean they should build or have to build or will build, right? And so they'll build when it makes sense to build. And that's one of his good observations I find on the market, is that, just rezoning is not going to lead to more housing, right? It still needs to be profitable for the builder. And I think what he's alluding to here is just one of the challenges of new builds, and when a lot of those new builds are owned by investors, and this happens in the off-the-plan space as well, when that build finally finishes, you could have 50, 60 apartments available to rent. And in build to rent, every apartment's available for rent. And so what you can do is you can flood the market, and renters basically feel like they've got a lot of choice, and they start low, and rents start off too low. Whereas if you drip feed them out, you then just catch the people who are a bit more desperate and are willing to pay a higher rent, and then you get everyone on a decent rent. So rather than having a whole building on a smaller rent, I don't know, it's a catch-22. If you're a developer, you can't be arguing. If they're going to all the risk of building and investing the money, they deserve to get a return on equity and a return on their investment. But, when you've got a homelessness problem and you've got a real vacancy problem, it sort of goes a little bit against those ethics to hold them back for your profit. So I think it's a bit of a catch-22 here. But this is one of the issues. Like, I know this is build to rent we're talking about, but this happens in the off-the-plan sector. They all of a sudden, the building's owned 70% by investors. All the investors can't afford to wait 6 months till they get rent. And then I remember I did this in London. I went around to rent something, and they said, which one do you want to rent? They're all available, because it was a brand new build. And I was like, well, they're all exactly the same anyway. Which one's got the best light? I'll go for that one. And, people usually pick the better ones. And that's one of the problems when you're buying off the plan, if you didn't get one of the better ones. And usually you don't, because the best ones usually get snapped up by the developer or their friends and family or their connections or the people selling them. The best ones are usually off the table straight away, and then they sell the dregs to the public. So that's my take on this story, is just the challenges of new stock entering the market and how that affects sort of investment returns.
Absolutely. I mean, yes, you're right. The idea that you just rezone a suburb, a city, and supply is therefore fixed permanently. I mean, this has been a big point of debate, including by Cameron Murray and others, because Auckland went through a big rezoning process, and there was some suggestion that rents have not been increasing as quickly in Auckland as in, say, Wellington, which hasn't gone through the rezoning process. And yet, just in the past few months, with international students coming back, suddenly apartment rents are rocketing again in Auckland. And look, closer to home, if you think back to Brisbane in 2016, there was a lot of apartments being approved, but developers like Gurner and others and Mirvac and Lendlease, they basically just said, well, we're not going to build these because the market is already saturated, and they sat on them, and then some projects were sold off and some sites were released and so on. And then fast forward, only 5-6 years later, and now we've got chronic undersupply, which you wouldn't have believed in Brisbane back then. So interesting, there was just a story in Urban Developer this morning. So they've had their Melbourne long lunch event over the past week. Time and Place founder Tim Price was saying basically that projects are just not feasible at the moment. Less than 10,000 build-to-sell apartments have been delivered in 2023, which is 40% below the pre-pandemic years. And yes, there's a lot of projects being marketed, but many of them are just being scrapped or delayed because they just won't stack up. And I think that goes back to your point. The developers don't build if they're not making a profit. Charter Keck Kramer made some very similar points, basically, and just saying that conditions, particularly in Melbourne, where the lunch was being held, they're arguably some of the toughest they've ever been, because the price of construction and labour has moved so rapidly over the past few years that in that context, higher construction costs, consumer sentiments down, basically just so many build-to-sell projects are unfeasible. Pre-sale rates have collapsed, projects being abandoned left, right and centre. So it's not quite as simple as rezone and everything gets built and fixed, because, well, we've seen close to home in Brisbane, that just isn't the case.
Yeah, and I think we've been on about a few times on this podcast. I think the developers have had the short straw for many years, not just with weather and COVID and materials and things like that. And they're getting blamed now, which is not really. I think it's the government's got a lot of blood on their hands, I would say, in terms of been targeting investors and pushing people out of buying properties, which is causing the rental crisis, to be honest. I don't think it's the developer's fault. So I think it's a easy target, which isn't the right target. So story number 2, Pete, property forecast. What we got going on here?
Yeah, well, actually on that point, I mean, we've got record high immigration at the moment, and that's starting to become a very regular topic of debate and discussion in the media. So I think there'll be some pressure on the government to make some changes. I was just looking at the total rental listings figures over the past 5 years, which PropTrack reported this week. And for September, they're way below. They're 25% below where they normally would be. But yes, there's often a recovery October, November, but December is usually the lowest time of the year for rental vacancies, and that's coming right up. So in the next couple of months, so we're going to see probably some quite alarming figures on rental vacancies over the next few months. Now, yes, in that context, predicting the future, or what's the old phrase? Forecasts are very difficult, especially if they're about the future or whatever. I've probably misquoted it, but 2024 property forecasts were released. Fin Review article this week. A panel of economists have predicted a 7% increase for FY 2024 for housing prices across Australia. Now, the most bullish in the market seems to be our friends at SQM Research, looking at 11% increases for Sydney, 7% for Melbourne. Carlos Cacho at Jarden, who's also been on the show lately, is looking at more like a 6.5% increase. AMP looking at around 7%. Likewise, Barrenjoey economist Joe Masters about 7%. So I guess the general vibe, Chris, is sort of ongoing price growth, but maybe not at such a rapid pace as tighter interest rates start to bite. But I suppose a bigger question above and beyond all this is it even worth listening to this type of forecast? Should we pay any attention? Does it impact how people should think about their strategy?
Look, I think there's a bit of groupthink goes on with the market. Everyone's believing the same thing. They're all reading the same data points. I think even after this report was probably produced, the expectation of another rate hike shifted, right? It was pretty low chance to now it's pretty decent chance of a rate hike. And, they haven't factored that in. If it's 2 rate hikes, that's not factored into their forecast, I think, at the moment. So I think it is a bit of a fluid thing at the moment. I think listening to forecasts is pretty dangerous because you don't buy the Australian or the Sydney property market. So what that does doesn't really matter to you. What matters to you is your property in your suburb on your street. And that could be completely different. But ultimately, I think it's showing that there's momentum in the market. But CoreLogic have even come out this week and say, oh, look, our monthly numbers are starting to really roll off. And, our annualized rate's actually falling now because our monthly rate. So I think there's a bit of affordability. And that's what Jarden were basically showing, that, if rates stay high, or the expectation they're going to stay high for longer, and we've still got really tight borrowing capacity, there must be some steam that's going to run out in the property market. But, I think as we talk in story 3 here, Pete, there's a lot of intergenerational money that is flowing down that is supporting prices on ridiculously low listings, both as a rental. So it's not great to rent right now. Everyone's feeling the pain, whether their rents are going up or whether they're getting kicked out or they're having to swap locations and they're having to, compete with Lions, or they're looking to buy and there's no great stuff on the market. So, I'd say that if those things continue, which I probably reckon it will with the rental listings, because you can't see more investors entering than more investors leaving. And I don't think many people are going to want to make big property moves, A, because they can't, and B, because it's not desirable to do so under higher interest rates. And so, that listing should also stay quite low.
Yeah, I think you're right. It's interesting you mentioned the groupthink there. That's definitely the case, and it's probably the biggest criticism that's levelled at sort of the predictions and forecasts, is that they all tend to cluster around a central viewpoint. It's a bit of a career risk to go too far out there from the sort of the central or median market expectation. But then, something comes along like the pandemic, and it renders all the previous forecasts completely useless, and we question the value of them. When we look back at what was said a year or two earlier. Just to wrap up on some of the predictions there, Ben Phillips, Associate Professor at the ANU. I've got a lot of time for Ben, by the way. He puts out a lot of very original and insightful content. I think at a time when quite a lot of academics have been criticised for some less valuable content, shall we say. But Ben's always got some really good insights on what's happening in the economy, household incomes, wealth inequalities, just a really good analyst and with a great understanding. He said the price growth will likely be strongest in Perth at around 13% and Adelaide at 15%. He said South Australia and WA are running pretty hot. Both have strong economies at the moment and plenty of momentum in both house prices and their rental markets, which, I tend to agree. In particular, Perth, the population growth in WA is booming along. And I guess going back to the point on market cycles, the construction is no way keeping pace now. It's so different from a decade ago when we got the overhang at the peak of the mining boom. So, interesting predictions there. And there's a few insights on mortgage arrears, which are, of course, expected to rise as interest rates go up, and that flows through. But most of the analysts suggest that people appear to be holding on and only a modest increase in arrears expected. So, pretty interesting stuff. As you say, always sort of caveat or put an asterisk against some of these things because you never know how they'll play out. Chris, third story of the week, well-heeled splash out on property and travel. So this was a piece in the Australian. So despite looming rate rises potentially coming as soon as November, buyers are still splashing out on $2 million plus homes and especially $5 million plus homes. And people are still traveling overseas a lot. So clearly the interest rate hikes aren't impacting all Aussies equally. I saw the retail numbers were also surprisingly good in November. I think the ABS mentioned unseasonably warm weather, plus the iPhone 15 was released. I was actually one of those people queuing up in Sydney, sadly, to upgrade my phone. So we can expect another tap on the interest rate lever, I think, in November to increase that cash rate again.
Yeah, it's an interesting story, this one. I definitely think that, particularly the higher end homes are absolutely getting a lot of intergenerational wealth, and there's actual urgency there to lock these in, because they have seen price rises over the last 12 months, right? And so we've had a $13 million purchase, we've had multiple $4 million purchases, a few in the threes, etc. So, and these weren't happening 12 months ago. There was a real fear in that marketplace. It's interesting. One of the quotes is Alex Phillips at PPD. Chris Joy was referencing him, just only 6 months ago and saying, all my sellers are looking to rush to the market. I've never had so many calls for people worried about interest rates. Well, he's actually saying it's the market's very hot in the $3 to $5 million range, which means that it's great for sellers. It means that very hot is mean when there's a fast market and buyers are willing to put down big amounts of monies because the buyers are really confident. And so it goes completely against what, the Chris Joy was using in his example for Philip Donnelly, 6 months ago, that everyone was rushing to sell, which I just didn't believe. I thought it was bollocks. So, I think there's a lot of intergenerational money, and I think people are willing to pass that down if they can. I think the super laws, and I think that's got to be playing into that wealthy mindset. If we're going to start paying money on this tax in super, why don't we just give it down to the kids now? We've got enough. And this really means they can stay in Sydney with the grandkids and things like that. So, 2, 3, 5, 10 speed market, right? There's not all the market doesn't move at the same pace, not to cities or, price points or even houses versus apartments. And the more that you sort of get to understand that, the more you switch off from those big stories like we spoke about in number 2, the forecast, and you start getting granular and you start thinking, okay, where am I looking? What's my next move and my next move after that? What are those markets doing? What can I do is it best for me to make a move now, or am I best to wait another year? Or should I sell that investment property, or should I just sit on the sidelines? Or your personal decisions can be completely different because the market's moving at different speeds in different parts.
Absolutely. I saw one of the quotes in the piece. Travel agent Kylie Brunwell from Flight Centre unit travel partner says demand remains extremely strong. Says that like a lot of the real estate agents, despite soaring interest rates, it just hasn't slowed the demand at all for international travel. She said her average client would be 50 plus. They paid off the mortgages, but also people, I guess, having been denied the opportunity to travel, they're really focusing on living their best lives. So I think, yes, there's a combination of the intergenerational wealth. We've got record high immigration. That's not really helping the inflation story either. But I think, going back to your point on stock, I was looking at the credit growth figures this week released by the RBA. This housing rebound hasn't been driven by credit growth. It's been flat basically all year. And for investors, it's been extremely anemic. The housing rebound has been driven by low stock. We've been tracking a number of units and apartments in Brisbane. We saw one this week listed, sold within the first 5 days, bang, 90% price increase since 2020. That was in Taringa in Brisbane. We've seen plenty of examples of prices up 50% plus in 3 years. So, but that's nothing to do with really booming credit growth. That's just a very, very low stock. And maybe it's more of a capital city story now than a regional thing. But I saw another interesting story this week. Commonwealth Bank's loan book has shrunk for 3 months in a row. First time since, I think, 2004. So there's going to be a lot of competition from lenders next year to try and get market share back. And I think that's already starting to happen, actually, with some of the lenders looking at longer loan terms and 95% mortgages. I think, we're going to see, I think, an interest rate hike on Melbourne Cup Day. I think the new governor probably needs to stamp some authority and show we're going to bash inflation back to target. I think if I was, that's, on the downside for the housing market, and particularly for sort of highly leveraged borrowers. I think I was taking a more optimistic view. I think Australia's inflation story, we're running quite a long way behind the rest of the world because we stayed locked down for longer and the borders stayed closed for longer, same as New Zealand. But if you look at Eurozone inflation today, the headline rate of inflation was down to 2.9%. So they're nearly back to target, and they'll be talking about rate cuts again soon in the Eurozone, no doubt. And some countries are already in outright deflation in Europe. And then JP Morgan put out a piece today. US inflation looks set to fall from 3.7% in September to 2% by the fourth quarter of 2024. So ahead of the Fed's schedule. So look, at the moment, it's all, it's the end of the world and inflation's rampant. But actually, inflation is actually sort of trending lower in Australia. And I think we're just further behind on that story. And we've still got, some very high readings on certain things. We've had energy prices and fuel prices. But eventually, things will start to normalise. But we might have to suck up another rate rise or two first.
I think that's what I love, Pete, about yourself. You've got that global view. I think one of the best things I did was when I was 20, I moved to London, right? And, I literally couldn't have timed it any better. I moved in 2007, pre the GFC, and then lived through the GFC.
Of fire.
Yeah, my first week on the job as a financial advisor was when Northern Rock went under. Bank run, it's just crazy. And to experience that and experience a true recession over there and unemployment to really jump and what happens when interest rates fall and businesses. And then I came back to Australia on holidays and then moved back in 2011. I was like, everyone was so positive and optimistic. And it just shows you that the world, is, acting in different ways as well. Like I spoke about the property market. And I think you need to get that global view, not just, the fear of what's happening here right now. I think, what's happening with inflation around the world? What's the story, and maybe you get a bit more confidence that maybe the inflation is going to get under control. I would say that higher rate rises, though, let's say that is coming. I would say that means that rate cuts are going to come sooner, right? Because you're going to have to come off a higher base. They are doing what they're meant to do, then you would cut sooner rather than wait later under higher rates. Secondly, I reckon it means less supply. I think if you were thinking about doing an upgrade, you're maybe building some confidence to do it when rates were, say, 4.1. But if rates go to 4.6, you're like, let's just hold off. I'm not sure if rates are going to. And so that's going to constrain supply even further. And that's what's going to. And then you're also going to see some positive momentum in prices. And so I don't think it's, higher rates will lead to more listings, because that's what most people think is higher rates mean more arrears, more people sell. I don't think you're going to see too much more selling, because people will try to stay in their homes, they'll try to get through it. And then even if they do get into trouble, they'll go to a bank and they'll get a payment holiday. I don't think they'll just rush to sell, particularly because the market's going up. Because they'll go, if I sell now and then try to buy in 12 months' time, I'm going to have to pay more. I'm going to pay stamp duty, selling costs, and I might not be able to get back in. I can't rent anything. My only option is to stay and get through this and stay with my mortgage and keep paying my mortgage. And so I reckon higher rates, or the fear around higher rates, will just recreate what's happened over the last 12 to 18 months. Very low listings. And that actually will be supporting prices, not making prices fall.
You mentioned groupthink just before. It's very interesting, actually, with the inflation figures. So the median market expectation for headline inflation in the third quarter of 2023 was 1.1%. Inflation came in at 1.2%. So virtually on the money, but the core figures were a bit above expectation as well. And straight from that outcome, suddenly we're talking about we must hike interest rates, get inflation down sooner. Inflation's too sticky. I mean, inflation has fallen from 7.8% to 5.4%. By next quarter, it'll be about 4.5%. So yeah, for sure, the RBA would have liked it to have been 4% by the end of the year. But the downtrend is really embedded. But all the economists are straight on to rate hikes. Market expectations are now looking for an interest rate hike on Melbourne Cup Day to 4.35%. And there'll be some talk about whether we get another one, even potentially to 4.6%. Now, as you mentioned there, Chris, let's war game this. So what does that do to borrowing capacities? Well, it takes borrowing capacities down a bit further. But here's the other thing. We've got so many developers who are teetering on the brink of going into insolvency. We saw 783 construction businesses and developers go broke in the last quarter. That's the highest we've got across all of the available data on the ASIC data series. So that's not gonna help if we get more interest rate hikes. It's just gonna smash confidence for people buying new apartments or new builds, or to construct new property. So that's just going to add to the pain for developers. And, the winter period's always hard for developers anyway, seasonally. So that we've come off the back of some very significant pain there. Mortgage arrears, yes, that will start to trend up. I think what we're seeing generally in the market is that owner-occupiers are just not selling, because where are they going to move to? There's no stock. Some investors, on the other hand, have been selling. And that would presumably accelerate a little bit if we got more rate hikes. And yes, rents are going up. But I guess this just comes back to the point. We've got a capital city rental vacancy rate of 0.9%. We've got the highest immigration we've ever seen. And investors, on a net basis, investors leaving the market. So the RBA's credit growth figures showed that quite clearly, that yes, some investors are coming into the market, but there's more selling. So that suggests rental vacancy rates are going lower still. And that was actually a point made in the Australian newspaper quite clearly in their piece, is that, people are spending $2 million on a first home in many cases. Why? Because parents are saying to their kids that the rental market's stuffed. And if we can get you onto the housing ladder, well, we'd rather get you a $2 million home in Sydney or Melbourne rather than have you struggling to find a rental. So, look, I think, rent, no question, consumer sentiment's already taken a sharp leg lower because people are expecting another hike. And it's not going to be good for the housing market short term. But I don't know that it's going to necessarily be the sort of catastrophic outcome that we tend to see predicted in the media, simply because there's no stock. There's nothing being built, or certainly not enough being built. Rental vacancies lowest we've ever seen. And is more tightening going to change that too much? Probably, nothing for the better.
Yeah, and you kind of brought up the bank lending side of the conversation before, where you said CBA loan books hasn't grown, I think, for 20, 30 years, for a quarter. I haven't got great love for the yellow bank. I would say that the support for brokers isn't the greatest out of all the banks. And they have a bit of a bank versus branch fight, really, I guess. And so I would say that the broker, because the broker market is doing so well, we're up to 70% plus of loans now, right? I did a Rask video not that long ago, 2 or 3 years ago with Rask, and I said 60% on that video, right? And, it was 2%, let's say 20 years ago. So the broker market share is growing, and in the UK, it's 90%, right? So, and I would say the UK system isn't as attractive to be a broker as it is in Australia, right? Because of whether they're remunerated. So, the broker market share, if it goes to 80%, 90%, and banks keep slushing down their branches because they're not profitable, that means the competition in the mortgage market's fierce, right? And CBA won't be able to rely on what got them there is going to keep them there. And I think that's what's issue is CBA's pricing has had to be cut. The banks have basically taken the foot off and said, we're not going to be as competitive with pricing, which created an opportunity for people like Macquarie, and ANZ went a bit harder. And so the banks basically have to offer amazing rates, which are very low margin for them compared to in the past, to get customers, because brokers are they're with their client decide where they're going to lodge that loan, because they go where the best deal is for that customer, not on because you had a Dolomites account there. And I think that's a real issue with the banks, not just CBA, but the banks who have been having this consistent credit growth and just living off these big bank profits. And also CBA have cannibalized their own mortgage book. They released a product called Unloan, which is in the marketplace, which is a low cost DIY digital bank offer that's backed by CBA, but it just undercut their own rates in the marketplace. So I think that was the greatest move personally. Well, you're also seeing bank innovation. CBA came out with 95% investor loans. You're seeing 40-year home loans enter the market at a couple of banks. We're seeing changes to the 1% assessment rate, happening with interest only. And so I think bank innovation around lending will be supported by APRA, because they need credit growth to continue for the stability of the housing market and the property, the bank profits. So I can see lots happening in the lending space where products are, getting more and more complex, more and more options, and any way to increase borrowing capacity. I think banks are going to argue for at the moment. Do we even have to discount rents for vacancy when the vacancy rate's 0.1%? Why isn't rental income just included 100% in this market? Because rents are likely to go up, not down. So that could happen. It's already gone from 80 to 90. So, yeah, lots to chat, Pete. And I hope you enjoy the rest of your birthday, and happy Sunday to everyone. Anything else we need to cover today, mate?
No, that's it. I think so. Just to wrap it up, thank you. Birthday cake time for me. So yes, developers deliberately worsening the rental crisis. It's our first story. Economists predicting 7% price increases for this financial year. And the well-heeled are still splashing out on property and travel. So you can blame them for the interest rate hike when it comes around on Melbourne Cup Day. And if we get any more beyond that. So I think that's about it, Chris. Birthday cake time for me. If you want to get in contact, talk about your portfolio, your strategy, you can drop me a line. I think there's a link in the show notes there. And if you want to get in contact with Chris at Blusk, he's always happy to have a chat too. So, Chris, thanks very much. Always enjoy our chats, and I'll see you next week.
See you next week. Happy Sunday.
Cheers.